Another strategy is to buy an at-the-money interest rate cap. In this case, that would be at 5%. So that means basically your interest rate is 5%, just where they are today. But if it floats up at all, you're fixed. Your hedge kicks in and you're covered. If it floats down to 4%, you're actually going to get the benefit of that. So an interest rate cap is a partial hedge because it's not a swap where you're actually swapping your floating rate to a fixed rate. You're getting a partial hedge, so you can still get the benefits of floating down, but you get the protection of floating up. And then finally, the third strategy is actually to buy an in-the-money cap where you actually buy the cap below where rates are today. So if you have a 5% rate today, you can actually go ahead and buy a cap at 4%. So that will day one actually start paying you every single month the difference between 5 and 4, which then effectively creates a synthetic fixed rate loan at 4% because you bought it in the money below where rates are today. And you can manipulate this, right? You can buy it as deep as you'd like. You can buy a 3% in the money cap.
It ain't cheap.
These things aren't cheap, right? You're buying it from a bank. These traders, they know the market. They're pricing in volatility. They're pricing in the forward curve. So this stuff's not cheap. You're basically paying money today to save on interest tomorrow. So it's kind of like prepaying your loan in a way. And obviously due to volatility, risk, time value of money, that can not necessarily be the best move. But if you want to lock it in and if you want to manufacture stronger cash flow, this can be a really great way to go. And also to limit variability because we're in this game to do well for our investors and to help our investors sleep well at night. And if you can lock in that in the money cap and take some of that variability off the table, pay a little more for it, it can be worth it. So that's a very popular strategy these days to manufacture cash flow through a floating rate loan. And that's true for an agency loan or a long-term floating rate loan. But as you mentioned earlier, it's also true for bridge loans. And bridge loans are most commonly floating rate loans. And people who are doing bridge loans today are most commonly actually buying deep in the money rate caps so that they can kind of create a synthetic fixed rate at a low interest rate so they can have cash flow. Because the reality of bridge loans today is they're expensive. And not many deals, almost no deals, truly have good cash flow on a naked bridge loan. Because if you're talking about SOFR at 5.3% and you're talking about a bridge lender spread at 3.5%, right, that puts you at 8.8, if I'm doing the math right. That puts you at 8.8% on your bridge loan. That's expensive money. So that's why people are doing what they're doing.